In this video, you will learn what a pattern in trading looks like, why patterns happen in trading, a clear step-by-step example of a pattern in trading that you can use right now, how to identify patterns, and how traders test their patterns. Hi traders, as always, it's Bruce Banks here, and let's get started on this trading tutorial. Today we're talking about patterns in technical analysis. One of the key things that technical traders use. We're looking for patterns in the market. Now, what is a pattern? Well, there's many patterns out there, all the way from candlestick patterns to range bar patterns to technical analysis patterns involving periods of time. A pattern is basically when you see a regular occurring theme in the market, a regular occurring event that happens when the market does a certain set, like bounces off a high regularly and then retraces down, so that you can trade off this pattern. We're looking for these patterns because these allow us to trade. Why do patterns happen? Well, if we look at this chart right here, patterns happen because all of the traders on this bar, all the traders here are reacting to what's happened back here in the market. And what's happening on this bar is reacting to the bar prior. We're always looking back in our data. We're always looking backwards to get a feel for what has happened in the market and what may happen in the market because of that. Also, there's stuff like news announcements and fundamental analysis, but we're not dealing with fundamental analysis today. We're talking about technicals because that's what we're trading. We're talking about the actual technical moves in the market and these technical patterns. So let's get right into a step-by-step example of a pattern in trading, because that's the best way to illustrate this. Now, we're going to be using a high-low pattern here. This is not the only pattern that is in trading. There is literally thousands, if not millions, of different patterns happening between all the different markets. But what we're going to be talking about is a high-low pattern. So a high-low pattern is when we get a high, we get a low in the market, and then we get a new high and then a new higher low. So what we're looking for is a upwards movement between the bottoms and an upwards movement between the tops. And that's the basis of a very simple pattern. So we'll circle off the rest of these. So we have a high, low, another high made, another low, and a new high, and a new low. And currently, if we look on the hard right edge, what we're waiting for is possibly another break of this high. So between these highs is a standard pattern. This is just one of many, like I said. So we're always looking for these lows to be increasing and these highs to be increasing as the market continues to move forward, creating this kind of band in it's not a channel. That's another pattern in trading, when the market bounces between a channel. When you look at this particular pattern, what we're doing is we're waiting for the peaks to be broken. So the way we're analyzing this pattern is we say on this first one right here, when we get this first high here, well, when we're waiting for the break of the next high, what does that mean? Well, it means that at this point in the market, all of the traders agreed that this is as much as this particular market was worth. And when we get a break of that, that means that the general sentiment of the market is up. Similarly, when we get the low here, because there will always be a bounce between the highs and lows in trading, and then when another low is attempted, it's higher than the previous one. So what does that mean? That means that as far as the bears were able to push the market down, on this second attempt, they were weaker. Their attempt was a lot weaker, and therefore there's more faith in the upside of this market, and especially with the break of the high right here. And that's a very simple start to a pattern. This is happening on lower time frames at the same time, and even if you look on lower time frames, you'll see down patterns in the market. You could even highlight them and even trade them. It's not to say you can't trade it downwards on a market that is trending upwards. It's just easier to go with the flow. So we're using this pattern analysis on this higher time frame to possibly find a directional bias when we're trading in the market. This is a very simple pattern analysis we can do. We can do this on a different market. Here we'll do the same. So we look initially for the high that was made here. We find the first low, we find a high, another low is made, a high is made, a low is made, another lower high is made, a low is made, and then what we get is a final break, because there's always going to be a shift in the trends in the market. The market will trend up, trend down, sometimes trend sideways. And what it means is, like we were talking about before, what we have is this consistent lower highs being made. This is just the same pattern as before, but in reverse. We're getting lower highs being made, lower lows being made. And then what we have here is a final break at this level. Every time we're going to be looking at these highs, since the market's going down here, we're going to be looking at the highs and be watching to see when this is broken. So we can see right at this point, the market broke that high and therefore broke this trend, broke this trading pattern. And at this point, when it breaks this trading pattern, we start looking for the next pattern that starts to emerge, which will be a high being here, then a low, and now a new high being made. We're doing the exact same analysis because these levels, when the market broke the current trend, the trend downwards, and made the new high here, we're going to start looking for a new low to be made, because there will always be the bounce back and forth. Now, the new low was set here, and the market started to go up again. And you'll notice that it was a lot easier to break all of these previous levels in this area, because the market already broke through this high right here. The market had that upwards momentum, and the momentum shift from a downwards trend to an upwards trend. This is a very, very simple pattern, but it's incredibly powerful to find the particular trend of the market and in what direction may be more beneficial for you to trade. So how do you identify these patterns? Well, one of the best ways to do is to backtest strategies. You can make a pattern, you can find patterns in many different aspects of trading. It could be anywhere from when the market goes up for multiple bars in a row, like say 4 bars in a row where consistent highs are made, look for possibly a reversal. And all you have to do that is find what you think may be a standard pattern, like a visual pattern in your charts, and then backtest that. Backtesting it being looking back at previous data in the market and then attempting to see if this pattern happens regularly. There are head and shoulders patterns for candlesticks. There are higher highs patterns for candlesticks. There are bullish flags for candlesticks. There are break of certain support and resistance lines that are patterns for candlesticks, or bar charts, whatever you choose to trade. Finding these patterns is one of the key things to creating a successful trading technical strategy. So one of the reasons that I chose this as an example, because this is a pattern that I have backtested. This is a pattern that I use regularly to analyze my charts. And what you want to do is, when you possibly see a pattern happening in your charts, and this is something that you get from, it's one of the things you get from a few hours and hours in front of a screen. You want to be paying attention to the market, and you'll start to see these patterns emerge. And as technical analysis traders, we're looking for trading patterns in the market. And whatever those patterns may be, if they're regular, it can give you that particular edge in the market when you're trading that pattern. A really interesting one to look up, and I covered it before in a video, is the turtle trading method, where he had a very simple pattern and he was able to apply it to multiple traders. They actually, it was a bet between two investors on if anyone could trade, and they just gave them this simple technical analysis trading pattern, and they found that even people that were not overly experienced in the market were able to trade a particular pattern. So you want to look for a pattern, find one, and then start to backtest it and see if it can be a start. All right, this was trading patterns and technical analysis. I hope you have a better understanding of how to possibly look for patterns, and I hope you actually choose to use the pattern that I used as an example here, because it can be incredibly powerful when you're looking for this particular pattern of higher highs and higher lows, or lower highs and lower lows in your trading, to give you a better sense of the general direction in the market, no matter what time frame you're using. Do you have any trading topics that you'd like covered? Leave a comment below and we can dive deeper into all things trading. If you just enjoyed the video, please subscribe or leave a like.